In the complex and often chaotic world of investing, where speculation and short term gains dominate the discourse, John C. Bogle offers a clear and intellectual alternative in the Little Book of Common Sense Investing. As the founder of Vanguard, Bogle presents a compelling argument that the most effective way to build wealth is not through market timing or stock picking, but through investing in low cost index funds that track the overall market. His approach, grounded in data and long term thinking, challenges the prevalent myths of active management and demonstrates that passive investing is the most reliable and rational strategy for most investors. For those who value reason over speculation and evidence over hype, this book offers a rigorous yet accessible framework for achieving consistent long term returns, providing intellectual clarity and a sustainable path to financial success. Chapter 1: The Case for Indexing. The stock market is often seen as a place of opportunity, where active managers and investors attempt to beat the market by predicting its movements and picking winning stocks. In this environment, it's easy to get lost in the complex world of financial products, strategies, and market speculation. However, the reality is that the vast majority of active managers fail to outperform the market in the long run. They are burdened by high fees, excessive trading costs, and the inherent difficulty of accurately predicting market trends. The core idea of indexing challenges the very premise of active management. Instead of trying to beat the market, investors are better off simply owning it. This can be done by investing in low-cost index funds that track the performance of broad market indices such as the S&P 500. By doing so, investors avoid the pitfalls of high management fees and trading costs that come with active investing. Index funds are designed to mirror the overall market, so they capture its returns without the risks associated with stock picking or market timing. One of the most compelling aspects of indexing is its long-term effectiveness. When compared to actively managed funds, index funds consistently outperform the majority of their counterparts after fees and expenses are accounted for. The data is clear. Actively managed funds often underperform due to the high costs involved in active management, as well as the challenge of consistently making accurate predictions. On the other hand, low-cost index funds allow investors to capture the market's average returns with far fewer costs. Over time, the benefits of indexing become even more apparent. By investing in an index fund, an investor gains exposure to a broad range of stocks, creating a diversified portfolio with minimal effort. This diversification reduces the risk of significant losses from individual stocks or sectors. Additionally, the compounding effect of reinvested returns helps to build wealth steadily and consistently over time. Another significant advantage of indexing is its simplicity. Active management often involves a great deal of research, analysis, and constant monitoring, which can be both time-consuming and stressful. Indexing, however, offers a straightforward, hands-off approach to investing. Once an investor selects an appropriate index fund, they can largely set it and forget it, knowing that their money is working in line with the overall market. In conclusion, the case for indexing is a case for simplicity, efficiency, and long-term thinking. By focusing on low-cost, broad-based index funds, investors can avoid the high fees and risks of active management and still capture the market's returns. It's a strategy that has been proven to deliver results over time, making it the most effective and rational choice for the majority of investors. Instead of trying to outsmart the market, the best path is to let the market work for you. Chapter 2: The cost of investing is one of the most influential factors determining the success of an investment strategy, yet it is often underestimated by investors. While many focus on picking the right stocks or trying to time the market, the reality is that high costs, whether through management fees, transaction costs, or taxes, can significantly reduce the returns on an investment. The key point here is that costs directly erode returns. Even small differences in fees can have a large cumulative impact over time. Active management, which involves frequent buying and selling of stocks, typically incurs higher costs. Fund managers charge higher fees for their expertise, often 1 to 2% annually. These fees can seem small, but over the long term, they add up, reducing an investor's final returns. Index funds, by contrast, typically charge much lower fees, around 0.1%, 0.3%, and their passive management strategy avoids the high costs associated with active trading. In addition to management fees, trading costs also play a significant role in reducing returns. Actively managed funds frequently buy and sell stocks, which results in higher transaction fees and, in many cases, capital gains taxes. On the other hand, index funds are designed to track a market index and are much less likely to engage in frequent trading. This passive approach results in lower transaction costs and fewer taxable events, ultimately allowing more of the investor's returns to stay invested. Taxes further compound the cost issue. Because actively managed funds are more likely to engage in frequent trading, they generate more taxable events, which result in higher capital gains taxes for investors. Index funds, due to their more passive nature, generate fewer taxable events and are generally more tax efficient, allowing investors to keep a larger portion of their returns. Over time, the effect of high costs can be staggering. Even an additional 1% in annual fees compounded over several decades can reduce the final return by a significant margin, sometimes by as much as 25% or more. This underscores the importance of keeping costs low when selecting an investment strategy. By choosing low cost index funds, investors can retain more of their returns, making it far more likely that they will achieve their long term financial goals. Chapter 3: The Role of Compounding. Compounding is one of the most powerful concepts in investing. It's the process where the money you earn on your investments, whether it's interest, dividends, or capital gains, gets reinvested, allowing you to earn returns not only on your initial investment, but also on the returns that have already been added. This creates a snowball effect where your investment grows faster over time as the returns start to generate their own returns. The real magic of compounding is seen when you give your money time to grow. The longer you leave your investment to compound, the more significant the growth becomes. A small amount of money invested early on can turn into a much larger sum in the future, thanks to the accumulation of compounded earnings. It's not about making huge returns in a short time, but about letting time and steady reinvestment work for you. The key to benefiting from compounding is to start early. The earlier you begin investing, the more time you give your money to grow. Even if you're just contributing small amounts, compounding will make a bigger impact the longer your investments have to grow. It's about consistency and patience, not trying to the market or find quick wins. To make compounding work to your advantage, you need a simple and low-cost investment strategy. Index funds are a great example because they allow your money to grow steadily over time without the drag of high fees. Since these funds track the market and don't involve active trading, you can let your investments compound without worrying about unnecessary costs eating into your returns. On the other hand, trying to time the market, frequently trading, or jumping in and out of stocks can interfere with compounding. These actions often end up slowing down growth because they disrupt the natural process of reinvestment. The more you interfere, the less time your money has to compound. Compounding works best when you give it time and stay patient. By starting early and sticking to a low-cost, passive investment strategy like index funds, you let your money grow with little interference. It's a long-term approach that pays off, proving that the real key to building wealth is not rushing the process, but letting it happen naturally over time. Chapter 4: Market Realities versus Expectations. When it comes to investing, many people are driven by high expectations of market returns, often influenced by the stories of big successes or short-term market booms. However, the reality of investing in the stock market is far different from the expectations many investors set. This chapter delves into the gap between what investors often hope for and what they can realistically expect over the long term. The stock market, despite its potential for growth, is inherently volatile. It can experience dramatic ups and downs, and while the long-term trend has generally been upward, there are no guarantees of consistent annual gains. Investors often have unrealistic expectations, hoping for quick and large returns, but this mindset can lead to disappointment and poor decisions when the market doesn't meet those expectations. The market doesn't always perform according to the hopes of investors. It follows its own cycles, influenced by a variety of factors such as economic conditions, corporate earnings, and investor sentiment. It's essential for investors to adjust their expectations to match market realities. Historically, the average long-term return from the stock market has been around 7% to 10% per year after inflation. However, this return isn't consistent from year to year. There will be periods of strong performance, but also times of market decline or stagnation. Understanding this reality is critical to avoiding the temptation to chase quick profits or panic during market downturns. Investors should focus on the long term, recognizing that the market's natural fluctuations are part of the journey. Short term volatility is inevitable, and those who are prepared for it are more likely to stay calm and stick to their investment plan. The goal is not to predict the next big market move, but to ride out the market's ups and downs while maintaining a diversified, low cost portfolio that grows steadily over time. Expecting steady, predictable returns can lead to a false sense of security, and when reality doesn't match up, it often leads to emotional decision making. Fear during market declines or greed during rallies can drive investors to make impulsive choices that harm their long term financial goals. By setting realistic expectations and accepting the inherent risks of investing, investors can better manage their emotions and make sound, rational decisions. In summary, market expectations often fall short of the realities of investing. While the stock market has historically offered solid long term returns, it's not without risk and volatility. By understanding the market's true nature, investors can set more realistic expectations, focus on long term growth, and make informed strategic decisions that align with their financial goals. The key is to be patient, stay disciplined, and avoid being swayed by short term market movements. Chapter 5: Voices of Experts. In the world of investing, expert opinions are often sought after, but it's important to recognize that even the most well known financial experts are not always right. This chapter looks at the role of expert advice in investing and the limitations of relying on market predictions, stock picks, and other expert recommendations. Experts in finance, whether they are fund managers, analysts, or economists, are often seen as having superior knowledge or insight into the market. However, the reality is that the market is unpredictable and influenced by countless variables, many of which are beyond anyone's ability to consistently forecast. While experts may offer valuable perspectives, their predictions are still based on uncertain and changing factors, making them no more reliable than random chance over the long term. Many actively managed funds, run by professional fund managers, fail to outperform the market after accounting for fees. Despite their extensive research and market knowledge, they still struggle to beat a simple index fund that tracks the broader market. This highlights the difficulty in predicting short term market movements and shows that past performance does not guarantee future results. Furthermore, expert opinions can often be contradictory. Different experts will have different views on the same topic, and their predictions can be influenced by their own biases, interests, or past experiences. This creates confusion for investors trying to decide whose advice to follow. The reality is that no one can consistently predict the market with accuracy. It is also important to be aware of the potential biases influencing expert opinions. Some experts may be motivated by the desire to sell a product, such as a mutual fund or financial service, which can lead them to make overly optimistic or biased predictions. Investors need to be cautious about relying too heavily on expert advice and should always evaluate advice critically. In the end, the most reliable strategy for individual investors is to focus on low-cost, passive investing. Index funds, which track the performance of a broad market index, don't require expert predictions or active management. They allow investors to avoid the uncertainty and risk of trying to outguess the market and instead benefit from steady, long-term growth. The simplest and most reliable way to invest often involves ignoring the noise and focusing on broad market exposure with a disciplined long-term strategy. Chapter 6: Asset Allocation. Asset allocation is one of the most crucial decisions an investor faces when building a portfolio. It involves distributing investments across different asset classes, such as stocks, bonds, and cash, with the goal of balancing risk and reward. The primary aim is to design a portfolio that can grow over time while minimizing the impact of market fluctuations. The key to successful asset allocation is diversification. By spreading investments across various asset classes, an investor reduces the risk of heavy losses in any one area. Different asset classes tend to perform differently under various economic conditions, so a diversified portfolio can help smooth out the volatility, ensuring that some investments perform well when others may not. There is no single formula for asset allocation. Each investor's strategy should be based on their financial goals, risk tolerance, and investment horizon. For instance, younger investors who have more time to recover from market downturns may choose a portfolio with a heavier emphasis on stocks, which offer higher returns over the long term but are more volatile in the short term. In contrast, investors nearing retirement may favor a more conservative approach, allocating more to bonds and cash to preserve capital and reduce risk. It's essential not to make frequent changes to your asset allocation based on short term market movements. The allocation should align with your long term goals, and adjusting it too often can lead to emotional decision making, which can reduce potential returns. Staying disciplined and sticking with your strategy is key to success. Rebalancing is also a vital aspect of asset allocation. As time passes, some assets in your portfolio may outperform others, causing your asset allocation to shift. Rebalancing ensures that your portfolio stays in line with your risk tolerance and investment goals. It involves adjusting the proportions of different asset classes to maintain the desired allocation. Ultimately, asset allocation is about managing risk and ensuring that your portfolio is structured to help you meet your long term financial objectives. A well diversified portfolio, tailored to your specific needs and adjusted periodically, is essential for steady growth while navigating market uncertainties. Chapter 7, Retirement Investing. Retirement investing is crucial for ensuring a secure future when you no longer rely on an active paycheck. The earlier you start investing for retirement, the better. By contributing even small amounts over time, you can take advantage of compounding and let your money grow steadily. Starting early gives you the benefit of time, allowing you to weather market ups and downs. A big part of retirement investing is figuring out how much money you'll need when you retire. This depends on things like when you want to retire, your living expenses, and future healthcare costs. Having a clear goal will help you set a target for how much you need to save and how to plan your investments. Retirement accounts like 401ks and IRAs are great tools for saving. They offer tax benefits, which can help your investments grow faster. Some employer sponsored plans even match contributions, which is essentially free money to help boost your retirement savings. It's important to understand how these accounts work to get the most out of them. As you get closer to retirement, adjusting your asset allocation is key. If you're younger, you can take more risks with stocks, which offer higher potential returns. But as you approach retirement, you'll want to shift towards safer investments like bonds and cash to protect your savings. This helps ensure you have the stability you need when the market fluctuates. Diversification is also crucial. Spreading your investments across different asset types, like stocks and bonds, can reduce risk and keep your portfolio growing even during tough times. A balanced, diversified portfolio is one of the best ways to safeguard your retirement savings. Lastly, it's important to review your retirement plan regularly. Life changes, and so should your strategy. Rebalancing your portfolio ensures it stays on track and continues to meet your needs. In short, retirement investing is about starting early, staying consistent, and making smart decisions with the right accounts and asset mix. By planning ahead and being patient, you can ensure that you'll be financially prepared for retirement. If you liked the video, don't forget to hit the like button, drop a comment, and subscribe so you never miss out on upcoming content. I can't wait to hear your thoughts and bring you more awesome videos soon.